The active number of homes for sale in Orange County has increased by 5% in the last few weeks. But what does that mean for the housing market? Let's talk about it. The market has had an increase of 113 homes for sale in the past few weeks, and now it sits at 2,276 homes, which is the largest rise of the year so far. But it's still the lowest level for an end of month of July since tracking began back in 2004. Not surprising, it is the highest peak since the start of February, but oddly enough, it has not surpassed its initial January level like it typically does. Inventory typically peaks between July and August, so we anticipate seeing the peak over the next month or so. But if you watch the show enough, you'll know inventory has been an issue for quite a while and it's been struggling to rise. But as I said in the last video, it's not because there's off-the-chart demand for housing. It's because there's an anemic level of homeowners who want to sell their home. And the truth is, I don't blame them. For those owners who are currently enjoying historically low rates that we saw during COVID, it's hard to bite off on taking an interest rate at the current levels that are between 6.5% and 7%. Last year, inventory was 69% higher than it is today. That equates to 1,652 more homes for sale. And if you look that the 3-year average prior to COVID had an additional 4,387 homes for sale, that's 184% higher, which is nearly triple where it stands today. And in my opinion, we will continually have this inventory crisis until rates come back down. Now let's take a look at the housing demand charts. We quantify demand by looking at the number of new pending sales over the prior month. In the last couple of weeks, demand has increased by 2%, which is roughly 38 new pending sales over the month of June. Demand has remained relatively flat since May. Over that time, it's gone up about 4%, so there's nothing really to write home about. When you look at today's numbers though, the demand reading is very similar to the demand readings of the Great Recession. But that is really the only parallel that these two markets have. The truth is, these markets aren't even that close. The Great Recession had a ton of inventory with low demand, which caused values to plummet. And short sales or foreclosures made up a substantial share of the marketplace. Homes in today's market are fetching plenty of activity, multiple offers, and typically selling either at or above asking price. Again, the only similarity to the Great Recession is the low level of demand. We can expect demand to slowly fall through August when the market starts to transition, and it will accelerate during the holidays. Last year, demand was 6% higher than it is today, and if we look at the 3-year average prior to COVID, it was 61% higher than it is today. All right, last piece of data to look at. This is the current days on market in different price ranges. Not much has changed in the last few weeks. Anything under $2 million is selling very quickly and it's a hot seller's market. On the luxury end, in the $2 to $4 million range, that has an average market time of 83 days, which is still a seller's market, but knocking on the door of being a balanced market. And the $4 million or higher price range have an average days on market above 250 days, which tends to be a buyer's market in those levels. But don't get me wrong, homes on the luxury end do still sell really quickly, especially when they're priced correctly from the beginning. If a seller overprices the home, it will sit on the market and wait for a price correction. So that's it for today's episode. I really appreciate you all taking the time to watch and educate yourselves on the market. As always, if you have any questions or if I can help you out in any way, please don't hesitate to ask. And lastly, please consider hitting that subscribe button and showing my channel some love. Talk to you all in a few weeks.